I made a video on this channel a few days ago regarding regional properties versus capital city. And what I didn't cover in that video was one, how it related to the 18.6 cycle and how the numbers actually work. When you're comparing the two, what is the better option? So if you're interested in what my thoughts are, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, if you haven't watched the first part of the regional versus capital city argument, then definitely go check out this video because it provides a macro landscape and gives you context around why we're even comparing the two when looking at our next investment property. I obviously want to jump into my whiteboard with some numbers, but first I want to start off with the 18.6 cycle and how this relates to regional areas and capital city areas. Now, traditionally what you'll find is in the first part of that cycle, you'll have the bigger capital cities move more in the first half of the cycle relative to the smaller capital cities or regional centers. And what you'll find is after the actual mid-cycle slowdown, you will see the second part of that cycle have explosive growth into the winner's curse. And this would traditionally be in the smaller markets, the markets that didn't experience as much growth as those that experienced it in the first half. So if you think about Sydney and you think about Melbourne, in the first half of the cycle, they had exponential growth, whereas the smaller markets like your Brisbane's, like your Gold Coast, regional centers, and like areas of Perth, you wouldn't have had as much growth. But after the mid-cycle slowdown, you definitely see some more growth, and those numbers are already coming out, hence why you're starting to see a lot of that growth in those areas. What you want to avoid is jumping in with FOMO into some of these areas. You still want to cherry pick the right locations, the right asset types, and the ones that are going to present to you not just great capital growth, but also rental growth. If you're confused or you just want to move at speed, because that is going to be very important as we go into 2024 and beyond, then definitely go check out this video. This is where I talk about how we can help clients actually go and build a portfolio, and it's pretty simple. It's all done for you, so you don't really have to do anything, and you get to leverage the experience of a team that does it full time. Now with that, let's jump into the whiteboard and figure out what the numbers actually look like. So it's regional versus capital city part 2. Now what we want to look at and focus on as we go through this video is growth. So that's both capital growth and rental growth, yields, and then vacancy rate. These will all play very important factors when you're considering any location. So if you're looking at regional, within those regional centers and you're comparing which one is the better suited for you, you want to be looking at these as a very high level factor. And I can't stress this enough, but location does actually matter, but not in the way that you think. We've always been taught, oh, just buy close as possible to the city and then you're going to get amazing amounts of growth. But if you look even just in your own backyard, look at the capital city you're living in and think about all the suburbs that are the closest to the center of that capital city or the main city hub, and then work your way backwards. And you'll find that there are some locations growing faster, even though they're further away. And this is why that argument gets turned on its head, where people are like, just buy as close as possible because that's where the growth is going to be. But when you actually dig deeper, you'll find that there are outliers and there's trends that you should definitely follow. Now, the other factor is, and I definitely hate this, but there's no way around it. When we look at the Sydney market or Queensland regional market, they're all made up of different suburbs, like hundreds and hundreds of suburbs. So when we look at like one suburb and we think all of it's going to be performing the exact same way, you might have this area perform well, but you might have this area really underperform. And that's why you need to consider that as we go through this, just because I'm saying regional center in New South Wales doesn't mean all of those regional areas are going to grow by that much. That's where you really need to back yourself when it comes to the actual research process. But if that's going to take you more than 6 months, well, guess what? If you're in a market that's actually trending and it's kicking goals, you're probably losing about $30,000 in that process because you're not entering the market. This is something that people don't understand, is when you're wanting to move at speed, you get in before the crowd gets in. So if you're trusting that research that you've done, you may already be late, and that could wipe off tens of thousands of dollars versus going out, outsourcing that whole process and going down that path. But what I want you to keep in mind is that it is not just one market. There are multiple markets, so take that with a grain of salt. Now, as I've mentioned, we're looking at regional versus capital city. Now, when you look at capital cities, there's like 8 or 9 of those. When you look at regional centers, there's like 30 of those. So when you're really breaking it down, it's so hard to do a direct comparison. You're going to look at averages, but we're going to have some assumptions, some boundaries, just so that we understand how this works, and then you can appropriate that into the areas that you're looking at as well. So in capital cities, you're generally looking at a price of $750,000. Now, just to illustrate my point, if you looked in Sydney, you're probably spending $750,000 on an apartment, but $750,000 in say Perth will get you an actual house. So you can see the difference. But then some would go on to say, well, Perth is technically a regional capital city. And that's a whole nother argument. I consider them as regional centers or smaller capital cities. Generally, the yield you'll find is about 3.5%. The growth rate I've put in here is 7%, and the vacancy rates are about 1.5%. For a balanced market, you're around that 3% mark, so 1.5. Again, we're in a rental crisis, so that should give you some context. When you start looking at regional areas, you're looking at a significantly lower price point at 450K, and that's for a house. And then when you're looking at yields, you're increasing your yield by about 2%. So at 5.5%, you've got strong rental demand. And then growth-wise, I've put in here 7% and a vacancy rate of 0.5%. Close to little to no listings when it comes to rental properties. That is a concern, but as an investor, you know that you have high demand, which means you get the highest quality of tenants as well. They're going to take care of your place and not miss payments as well. Now, just for context, when we're looking at, say, something like growth, it's so subjective, right? You would go, well, how do you know it's going to be 7%? Well, I can go and look at all of the data that I have for all the hundreds and hundreds of properties we've bought at Search Property, and I can tell you that we outperform 7% every day of the week. When we look at every single property we buy, we're looking at more of an average around sort of 10+%. While some people will look at this and be like, no, you're not going to achieve 7%. I know for a fact over the hundreds and hundreds of properties across all of Australia, we're doing more than 10%. I think we're being quite conservative here, and you could definitely go and pick up a property that doesn't perform that well, and then that would screw the whole numbers up as well. That's why it's important to get the research right. So let's look at the comparison. Let's focus on the capital city property first. So you've got a property there for $750,000. At 7% growth, you're looking at $52,000 a year in equity growth. In your rent, you're getting about $505 a week. Your loan is $675,000. Your deposit is about $75,000. Again, we're not accounting for all the stamp duty, your other expected costs as well, like conveyancing and things like that. But on average, you're looking at about a cash flow of about minus $20,000. So that would effectively mean that you're losing $20,000 a year just to hold this property. Now we're in higher interest rate environments. So 2 years ago, you're probably a neutral cash flow. Right now, you're minus $20,000. Now, if you're in a good area, you'll have that rental demand, which means your rents will continue moving up as well. And that will then affect your cash flow as well, because you'll have more income relative to the expenses as well. Now let's flip over to the regional side. $450,000, so about 300K less as an entry price. Your 7% growth is $31,000 versus the $52,000, which again is because a lower price point. Your rent here is $475 per week because your yield is so much higher. Your loan is about $405,000. Again, probably about $250,000 less than what you were getting here across in the capital city property. In your deposit, you only need to say $45,000. Again, we're doing comparisons on exact property as well, not factoring in stamp duty and things like that. So you're looking at a difference there of about $30,000. Now, if you're looking at today, you've got the cost of living crisis, everything's more expensive. How long does it take you to save an extra $30,000 for a deposit? Not only is your deposit higher, but your stamp duty is higher because the price point's also high. Your cash flow in this situation will be about negative $6,000. So if you were to break it down and go, okay, the capital city property is going to cost me about $400 to $500 a week out of my pocket to hold that property. For a regional property, when I'm looking at the right location, in my first year, it's going to take about $100 to $120 from my pocket. So if I did a like for like and I had the borrowing capacity, based on this, I could probably hold 4 or 5 of these regional properties versus the one when it comes to a cash flow only basis. Now you can start seeing the benefits of being in an environment where you have higher yields, because cash flow is important. When people come out and say, oh, it's just all about cash flow, it's all about capital growth. No, don't listen to that garbage. What you need is a combination. And the reason you need a combination is, think about it this way. We have interest rates high, right? So if you had gone out 2 years ago and you said, okay, well, interest rates are low. This is the best time to buy capital city properties. I'm going to go and buy 3 of them. So you buy 3 of them and you're happy. And then you realize, oh, interest rates are starting to go up. Okay, no, I'm going to stay variable and it's fine. And now you're in a position where each property is taking $20,000 out of your pocket. You do that across 3 properties, you're now forking out $60,000 just to hold the goddamn thing. Now, how long can you last holding that by paying $60,000? And what makes it worse is if you picked them up at the peak of the market, you probably saw a retracement of about 5 or 7%. When you compare that to the regional property market, a couple of years ago, they're positive cash flows, you're not worried. But now in a situation, you've got 4 of these and it's costing you $6,000 out of your pocket on each property, is about $500 a week. Now, $500 a week is $25,000 a year roughly. So 25,000 versus 60,000. You haven't really accounted for the rents increasing, but the main point is that cash flow is important from a day-to-day basis when it comes to holding these assets. Now, the capital growth is very important as well, because without the capital growth, you can't actually move forward, because you need the capital growth to get the equity, and the equity allows you to use that as a deposit to purchase more properties. A great way to think about what is going to give me a better return is to think think how long it would take for a property to go up by 50% in value. We know when it comes to real estate investing, we're here for the long game. We also want to know the return, cash on cash return that we get with our dollar. If you think about a property that's worth $750,000 to go up by 50%, it would need to go up by $375,000. So if you look at it from a supply and demand perspective, you would go, okay, I need people's borrowing power to increase to a level that's going to allow them to borrow an extra $375,000 to get the 50% increase. Okay, so just think about it because it's a bit different to how we've always thought about this. But to increase by 50%, I need this property to go up by $375,000. On this side, if I need this property to go up by 50%, I need this property to go up by $225,000. So again, what's more important? Is it the dollar value or is it the cash on cash return? For every dollar I put in, I want the maximum return on investment. So although on paper you're like 375 is higher than 225, that's 50%. I want that one. But the problem is that you're looking at it from the wrong lens. What you haven't factored in is one, the cash flow being lower. Two, affordability is a concern. And so when credit is slow, how do you expect people to afford so much more? And if you go back to the theory I've always had on the channel is that when things are turbulent, people will go and downsize. They'll go into things that they can afford, which is why the bottom quartile of the market actually moves up during these times as well. Now, the factor we need to talk about is affordability. When you think about a $750,000 borrowing capacity, or that's the maximum you can put towards this purchase, in a capital city like Sydney and Melbourne, you're probably looking at a unit. So then the other conversation comes up is the asset type. What's in demand, what's gonna grow, and what do you have more supply for, or what could create more supply? You're probably looking at high density living where you can have a new block of units go up, and there's not much difference between what that looks like and what mine looks like. So when you look at all the data that's come out over the last 30 to 50 years, you will find that houses do outperform units. So for me, I'm going, would I rather have a unit in a capital city or a house in a regional center that ticks all of the boxes for me? For me, it's a fairly obvious decision, but again, I'm gonna leave it open-ended for you. I hope you guys have learned a thing or two or have opened up your mind to actually exploring other locations because of this example. If you have enjoyed this video, smash that like button, subscribe if you haven't already. I'll catch you guys in the next one. Thanks guys.